Most people start trading by trying to predict the market's next move. They look at a chart and attempt to guess if the price will go up or down. But because the market is influenced by millions of participants, predicting any single move is nearly impossible. Guessing direction turns the chart into a coin flip where the odds are rarely in your favor. Jesse Livermore, one of the most successful traders in history, prioritized high risk-to-reward ratios over his win rate. His win rate was only around 30. Because these emotions are constant, the behaviors they create on the charts repeat. We can capture these repeating behaviors by building a mechanical, rule-based system. Today, we're going to use gold and the opening of the New York trading session to build a precise framework designed to move past guesswork. Shifting your focus to recognizing repeating human patterns is the first step from retail gambling to professional operation. Step 1. Open your charting platform and pull up the chart for gold, XAU-USD. Instead of watching the chart all day, we only look for setups during high-volume time windows. This is when institutional momentum is most likely to enter the market. To help us see these windows, go to your indicator search menu and type in FXN Asian Session Range and add it to your chart. Looking at this timeline, you'll see a highlighted vertical box. This represents the New York Open. For this strategy, we ignore the price action in the dimmed-out sessions on either side. Right before this New York session box begins, switch your chart to the 1-hour time frame. Identify the recent swing highs and lows and draw 2 bold horizontal lines right above and below the current price action. This creates a visible channel of support and resistance. Bounding the price within a specific time and structure standardizes your setup by replacing random chart watching with an objective framework. Now we wait for the trigger, a 1-hour candle pushing completely through either your top resistance line or your bottom support line. When this happens, do not enter the trade immediately. Buying or selling on the initial breakout is where most traders fail. Amateurs often chase the initial move out of fear of missing the trade. This frequently leads to losses when the market creates a false breakout designed to trap impatient participants before reversing direction. We require the price to curve back and touch the exact line it broke. This retest confirms the level is holding. Next, drop to the 15-minute time frame to pinpoint a precise entry as smaller candles react. Waiting for the retest acts as a behavioral filter. It ensures you are reacting to confirmed price action rather than acting on impulse. Your entry signal is a 15-minute candle closing in the direction of your trade, right off that retest line. Once that candle closes, the trade is active. Place your stop loss safely outside your established support or resistance zone. This provides a buffer so normal volatility doesn't close your trade prematurely. Our exit target is set using a mandatory 1-to-2 risk-to-reward ratio. In this chart, you can see the green reward box is exactly twice the height of the red risk box. This ratio means that for every dollar you risk, you stand to make 2. Mathematically, this allows you to remain profitable even if you lose more than half of your trades over time. Strict, non-negotiable rules for risk ensure that your account capital is protected regardless of the outcome of any single trade. Having a system is only the first step. You must now prove its viability across historical data before risking actual capital. You need to manually backtest this setup and log a minimum of 100 trades to achieve a statistically significant sample size. During this process, you will encounter losses. Hitting a stop loss is a standard part of the dataset and provides the information needed to see the strategy's true performance. Analyze these 100 trades to see if specific days or times consistently produce losses. If the data shows that Mondays are consistently unprofitable, you can refine the strategy by simply removing that day from your trading schedule. Systematic backtesting transforms a theoretical observation into a proven, data-driven business operation. We have replaced subjective guessing with execution based on time, structure, and managed risk. Identifying a breakout and retest gives you a visual pattern. A strategy requires you to layer on entry rules and the math behind your risk management. Your next step is to go to your charts and manually log 100 trades using this exact framework. Use a spreadsheet to track the day, the time, and the outcome of every setup. By seeing these patterns play out across hundreds of data points, you build the conviction needed to execute the plan when real money is on the line. This data converts abstract rules into a system you can actually trust. Ultimately, long-term market profitability is built entirely on data, discipline, and the consistent execution of a proven edge.